When it comes to inflation, a lot of what I say isn't necessarily going to be popular. Matter of fact, I don't want to say conflict, but I have a lot of, I'd say heated conversations where people are going to say, hey, Alex, you're crazy. All right, welcome back. 10 Fears of Retirement podcast. I am the author of the book and host of this podcast, Alexander Pushman. I'm a financial professional up here in Brighton, Michigan, and born and raised. So if you're just joining us for the first time or you've been following this journey with me, I hope you're getting a lot out of it. My goal always is that you walk away from the podcast and or the chapter of saying, hey, wow, that's one thing or two things that I wasn't aware of, because what I've identified in my career in this financial industry is awareness is half the battle. You got to be aware. You can't play the game if you don't know the rules. So this episode is episode 9, and we're in chapter 8 of the book. And we're talking about inflation, rising inflation, and some of those stresses and concerns that it brings into the retirement picture, right? So when we talk about 10 fears of retirement, I want to revisit this because I think it's important. I've done over 2,000 second opinions with families, candidly all across the nation. Obviously, a lot more isolated here to where I live in, Southeast Michigan. But of those over 2,000 second opinions, this book got started. And I talked about this in the first podcast and a little bit throughout, but you see trends and you start going through this stuff, talking to families, and you see trends, and usually the same few fears are popping up. So my goal is never to scare you. My goal is not to, make you worry, I'm going to have a bad retirement right now. It's more about being aware so that you can be proactive and work with somebody, do your research, and make informed choices. I always talk about that with the clients I work with and the families that I serve. Let's make informed choices. I want to go buy an RV. Well, how's that going to impact you short and long term, right? That's an income plan. So, I always do this, but to keep with suit, if you're somebody out there who hasn't taken advantage of chatting with me, my team, having a customized plan done for you at no cost, please take advantage of it. More importantly, if you haven't got the book yet, you can always go buy like the physical paperback, but also we will give you a PDF version or digital version for free. You just got to sign up with us, get involved with us. Once we know who you are, we're going to say, hey, here you go. That's kind of your takeaway so that you can take that and get some good stuff out of it. So not only you're here, but you're getting the good stuff in the book, and you have that for the rest of your life, okay? So please do that. Sign up, get involved. And again, if you want to take that step and connect with me personally, I invite you to do that. No strings attached. I love this stuff. I'm passionate about it. And again, I hope you're walking away from this getting some good things. So let's kind of dive into inflation. When it comes to inflation, this is going to be one of those chapters that I've mentioned it before in other subjects, but I'm really going to talk about a lot of what I say isn't necessarily going to be popular. And there's not an article that you can go read that's going to tell you what I'm going to say. Matter of fact, I don't want to say conflict, but I have a lot of, I'd say heated conversations where people are going to say, hey, Alex, you're crazy. And what I mean by that is inflation real? Absolutely, it's real. It is a real thing. Inflation exists. We all know it, right? You go to the grocery store, you're seeing it firsthand. You go to the pump to fill up your car, you're seeing it firsthand. So it's an absolutely real thing. But this is what I've identified through experience. And this is one thing that I would even encourage about every sector. I'm 40 years old. Every sector in the world is, whether it's a doctor, a police officer, a financial planner, I might be the greatest credentialed financial planner. I have a CFP, and I have this, and I have that, and I have this Series 65, Series 24, and I go on and on and on. But if you don't have real world experience, those certificates don't really do much. It's like I was talking to a professor, and he was a finance professor. And me and him were just chatting, and we were actually playing golf, and I was just asking him some questions. And he had no idea some of the really basic principles that I talk about every single day with retirees. And it wasn't that he wasn't a smart guy, and it wasn't that he wasn't educated. It was that he didn't have real world experience. And so real world experience is, I don't want to say just as or more, but there is an argument that, hey, you can have all the credentials and the licensing and you need to do that to operate in a legal space, but real world experience, that's the place where I've gotten more from any book, any training, any continuing education that I've done in my life. And so let's kind of direct that back to the topic for today, which is inflation. So to give you some numbers, historic numbers, historically, if I look at all of time in the United States of America, and I say, okay, from 1914 to 2024, the historical inflation rate is 3.3%, okay? So more recently, we've had some bigger numbers, right? In 2022, again, the average was around 8%, give or take, based on where you were at, your demographical situation. But if I also just go back over the last 30 years, inflation is actually closer to 2.34%. So it's actually a little bit lower in the last 30 years than basically 100 years back. So this is what I talk about. And I know we've talked about it when we specifically covered income planning in the podcast, but inflation, when I build an income report, I'm always going to tailor it to the person, where they live, their lifestyle, their spending habits, et cetera, net worth. But I historically will use somewhere between a 2 and a 3% inflation factor for their cost of living and needed adjustment. Here's the harsh reality, and this is the part where people will argue with me or not agree with me, is oftentimes I'll see a family live off the exact same monthly number for 5 to 10 years. And it's January 1st. I don't get a phone call from a client saying, hey, Alex, I need my 3% bump starting in January for the rest of the year. It has never happened. It has never happened in over a decade of me having these conversations and meeting with people and talking about their life savings and their monthly needs. So my point to that is experience matters. And is inflation a absolute real thing that we need to consider, and the power of our buying power and the power of money overall? Absolutely. But we also need to be realistic. Usually in the first 10 years, people will spend more than they do in the rest of their retirement, with the asterisk of those long-term care scenarios. So that's an important thing to consider. The first 2 to 3 years, and I know I've said this, I'm a broken record. I'll say it until I'm blue in the face. The first 2 to 3 years, I usually see more spending than I do the remainder. Why? Well, you got the honey-to-do list, right? You're upgrading the house. You might be doing things, going on trips you've waited to go on your whole life, buying those things that maybe you've been waiting to hold, and it's a celebration of your retirement. So when we kick back to inflation, to keep it safe, when I'm doing my income or capital retirement analysis or distribution plan, whatever you want to call it, I'm using usually between a 2 and a 3% increase year over year to keep the plan honest. Because the one thing I haven't said yet that's a very important variable is if you spend the exact same amount of monthly. Alex, I spend $5,000 a month. I have a pension of $1,000. I have Social Security coming in between me and my wife of $3,000. Okay, so you only need $1,000 out of your investments a month. Yep, that sounds about right. Okay, great. So I have a distribution set up where they're getting their $1,000 net. We're taking taxes out. They're getting it. And all of a sudden, boom, they need a new deck on the house. Uh-oh, furnace gave out. We need a new roof. Hey, we're going on a family vacation. We want to do something special for the family this year. It's our 50th wedding anniversary, and we want to do something special. These are the scenarios where it's out of the norm. It's not your monthly budget. And so we do need to account for those. And so not necessarily saying that inflation's not real. I'm really saying that I keep inflation in the plan to make sure and guarantee we account for these emergencies, for these medical situations, for these big trips or big expenditures that maybe aren't baked into our monthly averages. Are things going to be more expensive? Yeah. I'll use 2022 as a phenomenal example, though, to kind of, wrap this thing up on my point. It's 2022. My parents were teachers. They're not multimillionaires. They're very, simple folks. They got good pensions, very fortunate in that regard. They spend the same amount of money pretty much like clockwork, and they've done that. They've been retired for nearly 10 years now, and they spend almost the exact same amount of money monthly for 10 years. But when they've had these big expenditures, that's when I've seen the income go up. So again, we have to account for it. So keeping that 2, 3, if you want to be, again, more conservative, you go up to 3.3, 4%. I wouldn't go above that. I think you're overdoing it, and you'd be showing burning money that's probably not real. But again, it's a comfort thing. Every family's a little different on how they want that dictated and shown. So you keep it in there because you control your spending. In retirement, there are controllable factors of spending. And I'll go back to that 2022 with my parents. Historically, they'll go spend a couple months down in Florida or go south and kind of get out of Dodge in the winters up here in Michigan for, anywhere between a month and a half to 3 months. And in 2022, they didn't go for as long, right? They cut the trip short a little bit. It saved them about $6,000-$7,000 because it's crazy how much that stuff is to rent places down there. So that's an example, right? Maybe you don't go on the big trip in that year if inflation's crazy, right? Maybe you don't build the deck if you've seen lumber go up 200-300% like it did in 2022 and during the pandemic. You do have controllable things. What do you not have control of? You don't really have control of medical things, right? Let's just say, again, God forbid you get diagnosed with something serious like a cancer or something like that. Good news is if you have the appropriate coverage and your insurance and financial professionals are doing their job, you shouldn't have a huge out-of-pocket expense because you should have a quality medical program in place. So proactive to everything can help you, but also recognizing what is and what is not controllable for you. Hey, we want to put the deck on. Maybe this isn't the time. We push it out 1 or 2 years. The lumber comes back down. Now it's the time to do it, right? The conversation, that's the example I would use with my dad. They were putting a new deck on. I was going to do a new deck of my house. I was like, I don't really want to spend this much. So what I do, I went to Home Depot, grabbed that paint that's super thick that kind of fills in those holes, right? And hey, that bought me a couple of years. So recognize what your controllable spending areas are. A furnace gives out. An AC unit gives out, and you're living in Arizona. Listen, that's not controllable. You got to act, and you got to act now, and that stuff's real. That's why you still allow inflation to stay in your income plan and to stay in your distribution plan. But it's very, very, very rare. I have seen a family consistently say, hey, I need my extra 2. I need my extra 3% for the year. Believe it or not, it's actually never happened to me. So, have a realistic expectation with inflation. One of the things that absolutely does have inflation, to kind of segue from that regular, that kind of norm that I see throughout all these families, to the things that I also see as regular where inflation does 100% have an impact, is that qualified care situation. What do I mean by that? Qualified care, in-home healthcare where you have nurses in the house helping out. If you're going to a nursing home or a long-term care facility, those 100% do have inflation. I was just looking at a statistic the other day, and it was an astronomical number, and they compared 2004 to 2020. And in nursing, the in-care or in-home nursing care facility went up something like 70%. I mean, that's a big number, right? So we do need to account for that, because one of the greatest quotes I've ever heard when it talk about retirement planning was, there's no better retirement game wrecker than long-term care. There's nothing better that's going to ruin your retirement plan than a long-term care scenario where you end up in a nursing home. You're now spending $8,000 to $11,000. You can't do anything about it because the spouse passed away, or you have 2 spouses or one remaining that's in a really bad situation. So, you need to have plans around that. I know I've talked about that. I'll continue to throw solutions out. If that's somebody that you are, it's worth a conversation, because that is an area that I've talked about on these podcasts that you can get taken advantage of, and you need to make sure you understand all your options. Inflation is real. Income planning, I keep it in there to keep the plan honest, to account for emergencies, medical, and again, just, those grocery stores, those gasoline pumps that we see inflation. But absolutely, you need to account for it on the nursing homes, on the in-home care, anything related to that elderly care. That's a spot that it really hits hard, and you need to have a game plan. Net worth matters. if based on how much you have in what we call investable assets. I'm not talking about the house. I'm not talking about your cars, but investable assets, liquid, whether an investment, a bank, a stock, a bond, a mutual fund, an annuity, whatever it is, those are the things we need to eyeball, because at a certain net worth, you don't need to necessarily go buy expensive products because you are self-insured. Because that's the other thing I see is a lot of people are spending money on insurance that they don't necessarily need. Connected back to that long-term care, that inflation factor that will scare people and people will use as scare tactics to get you to take action. So recognize that when we talk about inflation, it's important we understand it. It's important we understand what it can and can't affect. And you need to really look in the mirror and pertaining to your situation on, what things can you control on your spending habits and which things can you not. Is it perfect timing to go redo your kitchen? Again, if there's all of a sudden a real issue with getting contractors and laborers and, different materials for construction, consider timing of your decisions, right? Interest rates. Hey, I had a client call me the other day, Alex, I want to buy an RV. I said, okay, how do you plan on funding it? Well, I was going to pull it out of my investments. I'm like, well, let's talk about it a little bit. How much do you need? Well, I need about $70,000. I said, okay. We didn't have it in the plan, which is fine. It's not my job to tell people if they can or can't do something. It's just to make sure they're aware of their short-term and long-term outcomes from making a decision. Where we landed was it probably wasn't a good idea to do this right now. Her husband passed away, and she's a widower. And, we decided that, hey, she's got a pretty packed calendar for the summer. The feds were claiming at the point in time when we're doing this that they were going to drop interest rates. They haven't done it yet. So, hey, let's wait a little bit longer because you have a jam-packed schedule for summer. You're not doing anything with this RV in the summer. It would be more of like a, next year winter thing. So we decided, hey, let's put this off. Let's see if interest rates come down. Let's see if those auto loans come down a little bit, and maybe it's a little bit more of an advantageous time to do it. Also, the investments have been doing well. Let's let those, compound and matriculate a little bit further, making some good gains right now. So again, it's all about understanding the economy and where you're at, when to buy something, when not to, what the reality is with what we should be using to be planning ahead on inflation, and also recognizing where the areas that inflation hits hardest. So these are conversations I love having with families because, again, I think people use inflation. I think people use running out of money, investment risk. They use them as fear to force people to make decisions they might not make. And really, it should just be an educational conversation where you have the whole scope of it so that you can make an informed choice. So when it comes to inflation, it's a real thing, folks. You got to make sure you understand. And the last thing I'll say before I kind of wrap up this podcast, this being a quick one, is it matters where you live. Inflation looks different in Brighton, Michigan, or Ann Arbor, Michigan, or Detroit, Michigan, a lot different than what it's going to look like in New York, New York, or in LA, or in Texas, or in Arkansas, or Washington State. We got to recognize also our demographics, and that gets into that unique family plan. Every family is different. Spending, goals, concerns and fears, medical, legacy cares. You got to understand your demographic, where you live, how that changes. Because again, if I look at my area, it's going to be a lot different than maybe somebody I'm talking to who lives in Naples, Florida, right? We got to recognize those things too. So make sure you understand that stuff. If again, I can't stress enough. I hope you're enjoying this. I hope I got you thinking. You need to have an income plan. You need to have an investment plan. You need to have a tax plan. You need to have an insurance and legacy plan, a comprehensive plan. If it's not me, have somebody you trust. If you have somebody you trust, and it's great, wonderful, but make sure you're having these conversations on an annual basis. Look at your inflation. What are they using in your income or distribution plan as an inflation factor? Not only for your income, but what's the COLA, cost of living adjustment, on your Social Security? These are the things where we see inflation directly tying in that you need to verify is in your retirement plan. If you don't, reach out to us, folks. I'll do this for you. No strings attached. I hope you enjoyed today. This was chapter 8 in the book, 10 Fears of Retirement. Again, I'm the author and podcast host here, Alexander Pushman. Hope you're enjoying it, and we'll see you next time. Keep coming back. And again, if you need anything, do not hesitate to sign up to set an appointment and or get your book if you haven't got the book yet. Thanks so much. God bless you, and have a wonderful rest of your day and week.